Okay. Well, first thing I want to talk about, I do notice a lot of people in the chat not really grasping risk management. I see, some people are learning it. They're kind of learning it the hard way by losing a lot and things like that. So there's two types of traders really. There's people that do it full time, that this is their main source of income, and then there's people that do it like kind of part time, like just a side gig. You have to understand that going into a lot of trades of like what type of trader am I and how much am I going to risk. So for example, a lot of people in here, they work full-time jobs, they have income. Your risk is going to be very different than somebody who trades full-time and that's their only source of income, because you have job, you have income coming in, so you can risk a lot more. Let's say you're starting out with a $1,000 account. I'm just throwing out a dollar amount. You're not betting your whole life putting food on the table for your family, paying your mortgage based off of that $1,000. If you are, you've got other problems, obviously. So, if you're starting out with $1,000, but you have a job, you have income coming in, it's okay that you can, risk a little bit more. You can kind of gamble a little bit more because you have that cushion of another job. So, if you're starting with $1,000 and you see a play that's posted that's $500, okay, well that's going to be half of your account. Does that mean if I'm trading full time and I have a $100,000 account that I'm working with, does that mean I'm going to put $50,000 into that one play? No, I'm not going to use half of my account for one play, because I know that that could go wrong and I could lose it, a lot of it or all of it, and now I'm screwed because now I don't have a job income to fall back on. So that risk um, definition is going to be a little bit different than somebody else's risk definition. So always keep that in mind. Yes, you're going to have bad trades. Yes, you're going to have losing days or even losing weeks, but you have to kind of constantly think about, well, do I have another job? Do I have other forms of income? Am I okay with that? Then, if you are, then that's great. Same thing with people that trade full time. They might lose on a trade, but if they have a lot of their money tied up in long-term accounts, then okay, fine. Friday was a pretty good example. Yes, sure, I lost a trade, but the market was up. So yeah, I lost that one trade, but I also have a lot of money in the stock market just in general. So my overall account for that day was up because majority of my money is in long-term accounts, long-term investments, stocks that I've been holding for 20 plus years. So it's okay if I lose a trade. That's why I don't really stress a whole lot if I lose a trade. It's whatever. I'm on to the next one. Um, Obviously, I use that trading income to continuously add to my long-term accounts, but I don't really care that much if I lose. I obviously don't want to. I want to win, but if I lose, it's okay because I still have a long-term account. I've got a dividend portfolio that's still growing. It's been growing for 20 years, and that's okay. Uh, so if you have a smaller account and you do lose a couple trades here and there, again, remind yourself, I have a job. I have a long term portfolio that I'm constantly adding to, so it's okay that I lose a trade, and hopefully that'll help with a lot of your guys' psychological stuff that's going on with trading, because it is a psychological game. Emotion does play a huge role in it, and I think part of that role comes from winning. There's positive and negative emotions, and a lot of people think when I lose it's going to bring a lot of negative emotions, but really the danger is those positive emotions. If you hit a 100% or 200% or 500% winner, you're going to think, oh, I can continuously do that, and now I have an edge. I can be a multi-billionaire because I know how to get 100% winner. Well, no, that's just luck. Part of it is skill and part of it is luck. So I always tell people the skill comes from if you're able to consistently secure 10 to 20% profits. The luck is anything after that. If you're getting 100% profits here and there, that's luck. That's not skill. Because no matter what, we can't really predict what the market's going to do. We can only take advantage of what it's actually doing. So if you get in a great entry and you're securing 10 to 20%, great. That's skill. That's a skill that can be learned. Um, but anything above that, it's pretty much luck. Um, so yeah, regarding just overall risk management, You guys have any questions on that? I wanted this to be more like a kind of like a Q&A session too. I know
Yeah,
we,
no, not necessarily questions, but I've been definitely following the plan, and creating stops and following it, whether it goes my way or not, Normally it's like 30%
yeah.
is what I've been trying to adhere to, and it's been working.
Yeah, no, that's good. A lot of people think that when they have a plan, it's only for profits and they celebrate wins. You should actually celebrate wins and losses the same. So, for example, if like, oh, I have a plan, I'm
You gotta
going to either take 20%
mute,
profit or 20% loss,
mute,
and
mute
it hits
Dean.
your stop loss, great. That was part of your plan. You stuck to your plan. That's what should be celebrated.
Yeah, I go both ways on that, right? And I really, it's changed my trading journey significantly, when I do that. Doesn't feel that great when I take the 30%, but I preserve my capital for the next one.
Yeah, I mean, you have to go into it knowing that you are going to lose trades. There's no one in the history of trading has ever had a 100% success rate their entire career. you know, that's impossible. If that were possible, then you would be the richest person in the world by far. You'd be the multi trillionaire. So you have to understand I'm going to take losses. I just need to minimize those losses. Trading plan and risk and all that stuff. I, as you know, I trade credit spreads mainly, and this is why. So if you can see my screen, this is optionstrat.com. I don't have an account. It says login, free trial, all that stuff. I don't have an account because I use the free version. People ask me to go on the site like, oh, how much is it? Should I go to this? Like, no, just use the free version. Who cares? Um, if you want to pay for actual data, you can, but I just use this to kind of show a reference to different strategies that are out there. So here's kind of a brief 101 on spreads in general, because I know, Dean, you were asking about them before. So we're looking at SPY. And if I want to take SPY, let's do, yeah, the August 25th, the 266 call. It's going to cost me $221 to get into this. And the only way that I can make a profit is if I beat the expected move, because that's all that option, the single leg options are. It's what is the expected move, and I need to beat it. So the expected move is basically saying SPY is expected to go up or down this certain percentage. So if you can beat that by going up or down higher or lower than that, then you'll profit. So that's why you run into things like time decay, and you're like, you see a stock is going up, but your option call is not, it's going down. You're wondering what the heck, that doesn't make sense. That's because you're not beating the expected move. So if I were to buy the 766 call for August 25th, you're really, what you have to do is you have to take how much it's being debited added on to that. So I'm not trying to get SPY to 266 by August 25th. I'm trying to get SPY above my break even, which is 268. So SPY really needs to be at 268 or above on August 25th just to break even. And I don't know about you, but we're not in this game to break even. We're in this game to profit. So SPY needs to go up 0.3% just to break even, and even higher for me to profit. So that's why you'll see, a lot of red right here, because in order to profit, it has to go higher than that. So that's buying a call. So if you expect the move to go up, you could buy a call, but it has to move higher than the expected move. What I like to do, instead of buying a call, I will sell a put. And I'll get into all this here in a little bit, but selling a put is kind of the same thing. If SPY goes up, I will profit. If SPY stays flat, I will profit. Even if SPY goes down, I will profit. I just can't have SPY go down too much. That's when I start losing. So buying a call is bullish, but selling a put is also bullish because you have to think about, when I buy a call, that means someone is selling a call. So when I buy a call, I want the price to go up, but when people sell the call, they want price to go down. Same thing with put. When I buy a put, I want price to go down, but when I sell a put, I want price to go up. because there's always buyers and sellers on both sides. Same thing with buying just regular shares. When you buy stock, just regular shares, you want the price to go up. When you sell it, you're hoping that you sold it at the top and you want price to go down. Same concept with options. So with selling a put, I'm actually profiting from that time decay and I'm profiting from the move. So the problem with that is with these selling is you have a max profit. As you saw from buying a call, max profit is infinite. Yes, technically it is infinite, and I'll show you why that is. It's in theory infinite, but in actuality, is it really infinite? Think about it. By August 25th, if I'm getting the SPY 766 call, yes, profit is infinite, but do you think in 2 days SPY is just going to jump up $400 or $40? Probably not. So I doubt it's going to go that high. So yes, in theory it's infinite, but in actuality it's probably not. SPY is not going to jump $40 in a couple days. If it did, I don't know. That's obviously some news headline and very, very, very unlikely. So really, in actuality, SPY might jump on a crazy move $20 in a couple days. So you're looking at maybe a max profit of about 500%. So with single leg calls and puts, your max profit is infinite. Your losses are defined. But the profit is really, you have to use common sense to be more of a realistic, what is my realistic gain here? With selling a put, your max profit's capped. So you cannot make more than the credit that you received. So that's kind of the downside of it. The max loss, I know people look at this and they freak out and they go, wow, I'm going to lose $76,000. You have to think about that. The max loss on just selling put is if SPY went to zero. If SPY went to zero, we have bigger problems in the world than me losing $76,000. I don't think that's going to happen. So the max loss on this one is also kind of like the max profit on the other example. It's probably not going to happen. But we still like to manage our risk. So no one's going to put $76,000 on the line for just that. So what we do is we add another leg. And if you add it to either in the money or out of the money, you'll see how it kind of flips. So if I add another leg that's in the money, now my max loss is only $56. Just keep doing that. Okay. My max loss is only $56. And as you can see from this, I'll make green if price goes up. I'll make green if price stays the same. Let me get more of a range here. And look at that. I'll even make some green if price dips down a little bit. So we're good. Little less requirements. So I only need $100 basically in my account to take this trade. The max loss I could ever lose is $56. That's if I just watch it go to zero, which no one in the right mind should ever watch a trade just go to zero. But if that were to happen, then that's the max loss. And that's my max profit. So that's why I like trading spreads. They're a little bit more defined as far as what my max loss is, what my max profit is. And I get a little bit more of a cushion because even if I'm wrong, I can still be right. But mainly, we do SPX here. And the reason why is because tax purposes, really. We get better tax advantages with SPX. So if I'm doing, let's say today's the 24th. I know it's the 23rd, but we're going to say it's the 24th. And I'm taking an out of the money put credit spread. I'm basically saying I don't think SPX is going to drop to 76.30. So if it stays flat, I profit. If it goes up, I profit. Even if it goes down, I profit. That's what I like about credit spreads. Sure, I'm not making a lot. My max profit's only $65. I'm not making a lot. Sure, I get it, but I'm consistently winning. I always use the analogy to people, a baseball analogy. Would you rather get one run per inning or 2 grand slams per game, and that's it? People think like, well, 2 grand slams, that'd be crazy. Yes, that would. But if I'm doing 1 run per inning and you're doing 2 grand slams per game, I'm going to win the game 9-8 every time. So yes, you'll be on ESPN, you'll be all the highlights, you'll go on the record books of one of the only people to ever do 2 grand slams in a game and all this stuff. But I won the game, and that's all that matters to me. I will consistently win that game. That's great that you got the 2 grand slams, but I won the game. So that's kind of what this with credit spreads are. Yes, I'm not making a whole lot, but I'm consistently winning because I have that cushion of just in case price goes down, I can still win. So that's
Yeah, I'm still getting used to that curve there, where it comes down to that corner. That kind of gets me rattled sometimes.
yeah. Well, I mean, this is where the time decay is huge, and you'll see this here in the next screen that I'll show. When it's kind of chopping around here, you're not really making a whole lot, but then towards like the end of the day, that's when time decay really happens, and you'll notice that when you are buying a call. So if I were to just buy an out of the money call, look at all that red. Yeah, yeah. SPX needs to go up and stay up because if it doesn't, it's going to drop off pretty quick. So that's why buying a call, in my opinion, is a little more risky than selling a put credit spread. They're both bullish, but one has a higher success rate, and that's all I care about is higher success rates. Any questions on that? It's kind of a spreads 101. And you could do the same thing with on the call side. So if you're bearish, if you think price is going to go down, you can sell call credit spreads too. So this is a call debit spread. So net debit, again, it's kind of like a single leg option. If price goes up, I only profit. But if it's a call credit spread, I want price to go down. And if you see that's a little bit more green, and even if price goes up a little bit, I'm still going to win. We'll talk about this too, this max loss of $480. A lot of people say, like, why would I risk $500 just to gain 20? This goes back to my, what I said earlier. No one's going to ever just watch your trade go to zero. We have defined stops here. We know when to get out. It's usually 2 or 3 times the credit that we received. So if I'm getting a $20 profit, I'm getting out at a either, 20 or 40, $60 loss. I'm not taking the full 480. Exact same thing when you see options being posted in the options alert, the single leg options. You're not going to watch it go to zero. You're going to manage your trade. You're going to manage your money that same way. We do the exact same thing here. Yes, you are risking that, but you are also risking the same thing when you do a single leg option. You're risking that full amount, but that doesn't mean you're going to watch it go to zero. Hopefully that makes sense. Let's get into what I do then. This table. These are credit spreads based on like actual. So this is SPX on the 15-minute time frame. And this is kind of a good example. Here, yes, I got stopped out on Friday, but I didn't know that giant candle was going to happen. Here's an example of a put credit spread. It's basically saying I want price to go up, but if it doesn't, I can still win. And as you saw, price kind of went down, went down, went down, went down, went down, but then it leveled off. So price ended up being closing lower than my entry, but if you took this trade, it's still a win. Because that is, let me go back to here. Hang on a second.
Where did you stop out on that? Right there at that green candle?
I'll show you.
The first.
I'll show you. So that's this. Price went down, and we were kind of hovering around this area here. But as we were hovering around this area, eventually towards the end of the day, that's when it flipped to green. So you have all this extra cushion. If it drops down too much, that's where you get close to your stop. But so in Friday's example, as soon as I got in, price came down here, and we were all kind of watching it or close to around our stop loss the entire time, and then it dipped just a little bit down to hit my stop loss, and then it recovered and ended up closing green because it was around that area. So that's what that's what was Friday. So this one's actually a little off. That it wasn't 760. It was, let me get it there. That's what it was. 7670 is the strike that I had. So as soon as I got in, yeah, we were hanging around our loss, and it's like right around here, right when it dipped at its lowest point. It's when it hit my personal stop loss, and I decided to get out. And then like 30 minutes later, we had this giant green candle, and it would have been a winner if I held it. But I couldn't predict that giant green candle. So it was trending down. It hit my stop loss. I have a certain dollar amount where I'm saying enough is enough. I'm out. I didn't want it to go to max loss, so that's why I said, stop the bleeding. Enough is enough, and that's okay. So
That
I took a
green
loss on
candle
that.
could have been red too at one point, right?
What's that?
The green candle could have went red
Exactly.
quickly
This
too.
could have easily flipped the other way, just like this. This was the last 15-minute candle. This is the last 15 minutes of the day, so that could have been even further. What I don't want, so that other screen with the option strat, what I don't want is I don't want price to close below this orange line. That's basically what I'm betting. So when I throw out my alerts, let me see if I think I can paste it on here. Can't I? Yes. Watch this crazy action here. Boom. How do I get back to my profit pirates? There we go. Okay, so this is saying the sell to open leg was 76.70. So I do not want price to go below 76.70. If it closes below 76.70, that would be my max loss. Well, technically, if it closes below both legs, that's my max loss, but we can get into that later. So I'm watching for the 76.70. So yeah, I mean, it actually went, if you look really close, price actually crossed over. It went below that. That day. It went to like 76.69. So it was like $1 in the money. So that's where I'm saying, all right, enough is enough. I don't want to take a max loss. Time to get out. But then, yeah, it recovered. But that candle could have easily gone the other way. So I did the right thing by managing my own money. Now, people with smaller accounts, let's say if you're starting out with $1,000 or $2,000, your risk might be a little bit different than my risk. And that's what I'll show you guys starting next week is kind of how to manage that smaller account, because of a smaller account, again, you have another form of income. So it's okay that you take some losses here and there. And your losses as a percentage could be bigger than mine. Me, I can't take those big losses because I'm not risking 50% of my account on a single trade. So my risk tolerance is going to be different than other people's risk tolerances. So starting on Monday, I'm going to trade as if it's like $1,000 account. So you'll see my stop losses are a little bit higher because I'm only risking a small amount of money, basically pretending that I do have another form of income. And then I have multiple accounts. So in one account, which I'll be posting, is like my quote small account. It will be what you guys will be seeing, and then my other personal account, I'll be posting what I normally do. But for the next couple of weeks, I just want to show you how to grow a smaller account by increasing your risk. And then you have to get to a point of, okay, well, now my smaller account has been growing because I've been taking these chances. When do I start to scale back? And then, we can kind of get into that discussion later. But that's kind of how I'm going to be tailoring my alerts starting tomorrow for the next couple of weeks. I'm not calling it a small account challenge or anything like that, because I'm not challenging anything. I'm just basically showing you hey, this is the risks that you should be taking with a smaller account. But again, I think I've mentioned this many times before. I'm not a financial advisor. I can't tell you what to do with your money or what stocks to buy or what positions to get into. It's legally I cannot do that. I'm just showing you, hey, this is what I'm doing with my money on my accounts. If you want to follow it, great. That's up to you. But this is what I'm doing. Okay.
Yeah.
Let's get
Good
rid of
stuff.
Okay, let's go into some of the changes on this indicator. I see a lot of people that use it incorrectly. They just, they'll put it on and they'll be like, okay, I'm gonna do that. Well, that's not really how it is. You have to kind of tailor it to your style of trading. And each one of these things are going to impact how you trade. For example, a lot of people will go, oh, I want early entry. So that's basically the first hour of the market. I want to be able to see all the signals that it's going to produce. So put credit spreads and call credit spreads. I'm going to have 0 for my confidence percent because I want to see everything. I'm going to hold it to the end of the day. This is going to be important. I'll show you why. I'm going to hold it to the end of the day. I'm going to trade all the signals. I don't care about the end. At the end of the day close, you have two options. You're either going to get max loss or max profit. So if you have end of the day close here, then you better have max loss here. It's not a very accurate representation if you say I'm waiting for end of the day, but I'm only going to take a 2 times stop loss. That doesn't make sense. You can't do that because at end of the day, it's either in the money or out of the money, right? So if it's in the money, that would be max loss. If it's out of the money, then that's max profit. End of the day close, max loss. I am offset will just be normal, the 0. So basically whatever it gives me, it gives me. I'm starting with $1,000 and I'm going to scale my account for every $500 I win. I'm doing that. Total contracts, I'll start off with 2. So I'm basically putting all my money into every single play. I am never closing the trade when I hit a take profit level. So for your practical purposes, I can even just take this line off the chart. This right here is a bad way to trade. And you can see that in my backtest table. It's a horrible way to trade because you have to think about what is actually going on. Early entry, the first hour of the market, as you know, is crazy. Premiums are high, market moves are, crazy. They go up and go down. We don't know which way the market is going to go at that point. I'm basically doubling my risk because now I have a high and a low by having a put credit spread and call credit spread. I'm taking all the signals, so I don't care if it's a low confidence or high confidence, I'm taking all of them. I'm waiting the entire day for the end of the day close, and I'm willing to do a max loss. Since this is a 0 here for my taking profit, I'm using my full position that I might get at the beginning of the day. And as you can see from the backtest table, yes, you have a high win rate, but because you have your max loss, that does happen, that will wipe out an entire account. So that's not how you should trade if you are doing, something like this, because that's reckless. This is to show you that if you do it this way, it's reckless. So if you do want to have an early entry, you have to recognize that, okay, early entry credit is going to be higher. So maybe I want to go for the higher credits, like, I don't know, 70. Okay. If I'm getting in early, I need to de-risk a little bit, not use my full account, and I need to get out early. I'm not going to risk the full thing right away. I'm going to get in early and I'm going to get out early. And I'm going to get out early at, maybe 50% of my credit. So if I'm getting at 70, I'm happy with getting out at 35. Okay. And as you can already see from the backtest table, you're now in the green because you have traded smart. You've planned smart. So you're already, your win rate went up. Your profits are now in the green because I'm now thinking of how an actual trader should be trading. And then only show confidence at or above a certain percentage. I probably don't want to do that. Maybe you want to go for higher. I don't know, like 50% or 40%, whatever. But you want to be in those high probability situations early on because the market is sporadic. So there you go. Look at that. The last 60 trading days, which would be not 60 days, but 60 trading days. So it's about, for what, 3 months. I've won every single trade, 100% win rate. I started with $1,000. Now my account's at 3,600. 33 for 33. So that's a winning trade. And if you have to ask yourself what's happening here, I'm taking a trade and I'm getting out early because I'm getting in early. I'm getting out early. Okay. So as soon as this curve hits, so this is basically saying, I bet price will hit this curve before it hits this line. And as you can see, each day, price hit that curve before it hit that line. Price hit this curve before it hit that line. Price, well, that was a fantastic entry. I remember that day. As soon as you got in, you would get out the next candle. So price hit that curve, and then we're done for the rest of the day. So you can see each day there was no trade here. Price would hit the curve before it hits the stop loss line. You get in here, price hit the curve before the stop loss line. That's why it's 100% win rate. Okay, because if that's how you want to trade, if you want to get in and get out early, this is how you would set it up. You would set it up how someone gets in and gets out. They get in understanding that you want to get out early, so you need to have, you know, a relationship between these two. Understand it's a higher credit when you do that. So you need to take a profit at a certain point. So I'm going to take, you know, make a half of my credit at that point. Okay. If you want to, you know, kind of play how the market, you know, I want to wait and see how the market does for the, you know, for the day. So that first hour, I'm not taking any trades. The first hour I can sleep in. Yeah, I don't know what time time zone you guys are in. I'm on the West Coast, so I want to sleep in until 7:30 instead of waking up at 6:30. Great. Um, Maybe I'm not doing end of day close because I'm not doing the max loss. So I want to do a stop loss. If it hits, if price hits there, and I'm not taking a max loss here, maybe I want to take only about 3 times the credit here. And since I'm waiting for plays later in the day, maybe I only want to take 80% credit. So I'm taking more credit. And since it's later in the day, I understand the credit's going to be a little bit less. So I will lessen my credit. I will look for maybe like a 50 or 55 credit for each one. As you can see, you know, yes, I have a loss. That's okay, but my account's still pretty good. It's growing, you know, very nice compared to the other scenario. So it all, again, this is all designed to be how, or designed how you want to trade. Okay. So figure out what works best for you. Don't just necessarily figure out what's the highest win rate or what's the highest account balance that you can get with this. You want to figure out, well, how am I actually going to trade? And I need to adjust these accordingly. Okay. Some people, they can't sit in front of the computer all day like I can. I'm watching the market, you know, all day, every day, Monday through Friday. So I can have my settings a little bit different than someone who wants to go, you know, I need to get in and get out because I have work in the afternoon and I can't watch the market. Okay, well then yours is going to be a little bit different than mine. So that's why I designed it the way that I did. Any questions on this?
I do. I just got to figure out where it is now.
Okay.
Give me one
Well,
second.
the new features on here, so this take profit curve, it used to be like a horizontal line, but it's in reality, it's more of a curve, a theta curve. So this was the horizontal line. So this was actually not that accurate. It's a good spot to take profit if price ever got to there. That's where you would basically close out all of it. But if you want to talk about actual time decay, it's more of a curve like this. So that's one of the new features. The other feature is that you can start, you know, account balance. You can put in however much money you want to start with and kind of see how that reflects on the P&L curve here. And then this contract scaling, what this does is adds one contract for every $500 you accumulate. Because with these spreads, you need at least $500 in your account to get them. So what I did with this was, okay, well, if I get another $500, that means I can scale, I can add another one. So, you know, if I'm starting with $50,000 and maybe I'm getting, I don't know, 10 total contracts and I want to close 8 of them when it hits that curve, which means I'm leaving the other 2 for the end of the day. Or this stop loss cross, it will calculate, you know, based off of all that. I'm going to be scaling my account based off that. So I started with 10 and I'm taking profit at 8. So that's what this is: start, current, and take profit. I'm starting with 10. I've scaled my account up to now I'm getting 152 of these at a time. And I'm closing 121 of them. So I'm getting 152 contracts, closing 121 contracts when it hits this curve. And in that 60 trading days, I have basically turned my $50,000 account into 121,000 using this method. So yeah, a lot of people kind of bash on spreads and are like, "Oh, I'm only, again, I'm risking $500 just to get 20." Like, yeah, that is true. You are risking $500 to get 20, but you're constantly getting 20 like every single day, and you're not risking the full 500 because you're not watching it go to, where is it? You're not watching it go to max loss. You're not sit there and go, "Wow, I'm losing all my money. What should I do? I guess I'll just keep watching it." Like, no, that's not what we do. We eventually get out, we close. So
Yeah, I
that's
think that's where they get a bad rap right there, because if you're one of those people that just set it, forget it, yeah, you're going to get screwed probably because you're not paying attention. But
exactly.
if you're paying attention, you're monitoring it, and you're working the plan.
Yeah. For example, I know this was, let me post something here. This. So TTT's Tesla play. Yes, it costs $325. Is anyone in here gonna just let it go to zero? You're gonna watch it go to zero?
Hell no.
No, exactly. You're gonna get to a point where you're like, you know what, enough is enough. Especially if you, let's
Well,
say you got 10 of
Dean
them.
might do. Dean will say he's packing a post up or something. I don't know.
Yeah, I mean, especially if I'm getting 10 of these, that's $3,000 on the line. You think I'm gonna just sit there and watch $3,000 go to zero? No, that would be stupid. Why would I do that? No. So yes, he is risking $325 for this, but he's not really risking the full amount. This is what he had to pay for it, but he's going to close out and get some of that back. Same exact thing with spreads. Yes, we are risking $500, but we're not going to sit there and watch it go to zero. I always tell people though, don't use. Yes, we are using 500, but don't use too much money. You have to still plan for worst case scenario. Let's say, you do put a whole bunch of money in. You're like, that's okay because I can watch the whole day. I can close out whenever I want. Okay, well, what if there's an emergency? What if your house blows up and you're, God forbid, you're in the hospital for 2 days and you finally wake up out of your coma and you go, "Oh, what happened? Oh, your house blew up, but you're okay now." But I got some more bad news. Because you went too heavy and you weren't able to watch, your position closed with max loss. So, welcome back, but it sucks to be you now. So that's what I think about too. Yes, I can sit here and watch the market all day, but I'm still not putting in all of my money just in case something crazy happens. I'm sure we've seen many times where we've had broker glitches. Like, oh crap, I can't close out of my position because something's going on. My broker's not working. And if you try contacting them, what are they going to say? They're going to say, "Oh well,
Sorry.
sucks to be you."
Sorry.
Yeah, they're not going to be like, "You know what? This was our bad. Let me go ahead and refund you $50,000." Like, no, they're not going to do that. So that's why I still don't even go too heavy with any of my positions that I'm in, just because I know shit can happen. So
Before you go, I need you to, if you could, just bring up that settings and show me the settings on the beginner so I can screenshot it.
this,
Now that's, oh, the 10, that wouldn't be me, 10 contracts, something like that. But
yeah. Well,
what
I
you
don't.
recommend?
Yeah, again, I don't know what your. Well, how do you want to trade? Are you a get in, get out early type person, or are you a get in and watch it for the whole day?
Oh, I would get in and take TP at wherever it told me to, really, and just get out. But
Okay, so well, get in early or get in early, get out early, or get in and watch it whenever. There's two
uh,
very differences, very big
yeah,
differences.
I would pass the first 30, 40 minutes of the day and take that next one.
Okay, so you're gonna wait. So you're not gonna get in early. You're understanding that the credit's gonna be a little bit lower at that time.
Correct.
Yeah, so then this would
About 3 weeks.
You ain't gonna be here on Sundays.
this would basically be kind of the allow put credit spread and call credit spread same day. You can obviously enable that as well, but that takes some different types of management as well, because I will typically, like, if I'm already winning on one side, yes, I will add the other side, but I won't add it as aggressively. Look, for example, like if I got 30 contracts for the put side and I'm already winning, and
Right.
call side now triggers, I'm like, okay, well, I don't technically I could add the other call side 30 contracts, basically free, not adding any more collateral to it, but I'm not going to do that. Like, I'm already winning. Why add more risk? I might only add like 5 or 10 and just get that little extra, fun money type. So
Right.
this
All right.
takes some managing as well too.
I went over my head. I lost.
That's
So
okay.
looking
Thank
down
you.
at the traction, is that,
It's not too much noise. It's kind of so just maybe.
I don't know if you heard me. You got it at 80%. That's normal.
Yeah, between like, if you're getting a lot of times people will just go, I want to expire at full credit. I'm going to get in and have it expire basically worthless. Yeah, yeah, you can do that. But if you are having a larger account, it's good to kind of scale your way out.
Right. Yeah. No, I'm gonna set that to like 2K. I'm gonna start just every day with 2K now, and see where I can get this.
Okay. Again, I don't know your risk tolerance. So with $2,000, the max you can get is 4 contracts. I don't know if you should be getting that. I always tell people leave some room. So maybe start with 2, close out 1, or start with 3 and close out 2 of them. And kind of just go from there and see, does this really work for me and how I want to do things.
All right. Hold on. Let me just screenshot that, and I can keep it.
And that stop loss, when you're looking at that on there, that's basically the top end of your spread at the time. And that's what that is calculating, the 50% credit. That stop loss would be basically your,
Yeah. So this stop loss is 3 times this 55 credit. So whatever this is. And the cool thing about this, I know this is a lot of information. You can always back test it really easily like this. You can just go test 1 day. Let me see how accurate this is for 1 day. So it's doing this little thinking thing. So in 1 day, I should have, it doesn't count this. Sorry, it doesn't count the day until there's actually another starting day. So maybe I gotta do 2 days. There we go. So
Good day.
I have 1 win because it was a $50 credit, but I got 3 of them. So 3 times 50 is that should be 150. I'm trying to think. Oh, I'm taking profit. That's right. I'm taking profit at 80% of the credit. So if I'm taking profit at 80% of the credit off this 50 credit, it would be 130. But if I wanted to go to max profit, that should be 150 off of each one. Thinking. There we go. $150 because I got 3 of them. If I'm only getting 1 of them and I'm letting it expire, it should show the same thing. It's thinking. And usually when you change these a lot, it takes a while to think. So just be kind of patient because it has to do a lot of calculations on it. So, so here I'm getting 1, closing out none of them because I'm letting it expire. This was a win, $50 credit. So there it is. If I want to do another day, so this was also a win. This is a $50 credit. So I should see 2 wins here, 1 put credit spread, 1 call credit spread. I'm now at $100 profit. So, it's pretty accurate as far as calculating everything. So you can always, back test it however you want to.
Is this thing going basically looking at current option prices? Once it sets it up, is that how it's taking that?
Yeah. Yes. Kind of. I got into a debate with TradingView's admin. They hate me, by the way. I should show you some of the conversations that we've had. Because at first they did not approve of having a backtest table. They said I needed to create it as a strategy. And I said, well, I can't do it as a strategy because you guys don't recognize what credit spreads are, because you could have a play like this being closing still out of the money, and that's counting as a win, but your backtest strategy would count as a loss because price did not close above this line here. So
Okay.
they had to basically like, okay, we'll give you an exception for that. But the other part is, so TradingView actually has live data, option data. The only problem is you have to pay for it. So I could have actual live option contracts data and have this be 100% accurate. But the only way that this indicator would work with that data is that every single person that has this indicator would also have to buy live option data. And I can't force people to do that.
Yeah, that makes sense.
So it's if TradingView made their live option data free for everyone, then yeah, it's an easy implementation. I actually, in one of my other beta testing versions, I've done it with on mine because I have live option data and it works perfectly. The option prices are exact. But again, I can't say, hey, you have to buy this, and now you also have to buy TradingView's option data. They're like, no, we can't force people to buy stuff. So what this does instead, I think it's called Black-Scholes modeling. Do I have that on here? I thought I did. Oh, that's kind of the same thing for theta. So what if you have time, you can just Google what Black-Scholes modeling is. It takes account stock option prices, or the stock prices, VIX, time decay, things like that, and it comes up with a model of this is an approximate of what the credits would be. So that's what it does. It uses basically Black-Scholes modeling to determine what this actually is. The downside of it is sometimes in the past, and we've seen this in the past couple of weeks, that the relationship between SPX and VIX is usually kind of inverse. If SPY is up, VIX should be down. If SPY is down, VIX should be up. But there's been times where we see like, oh, VIX and SPY are both green. That's usually because there's some sort of expected announcement or earnings, or we're all waiting for something. So VIX is a little bit higher, and then obviously if the stock market's higher, then that's just what it is. So when that happens, that Black-Scholes modeling kind of gets thrown out of whack a little bit because they're not following their same relationship. You should always see VIX and SPX to be kind of the inverse of each other, because that's kind of what it is. VIX is somewhat the inverse of SPY and SPX. But when VIX is so low at these levels, it usually doesn't get much lower than like 14 before they do another reverse split to kind of reset it and everything. But and here we are at 15. So at these levels, this is kind of off a little bit, but it kind of gives you just a general idea what the credit should be. So obviously cross-reference what your broker is showing. So Friday was a good example. 76.60 was not a $50 credit. It was actually 76.70 was a $55 credit. So it was close.
So I understand this, and I'm just asking just for the future. Do you have any plans of maybe having a full-blown spread channel for just any stocks that you get a call on, that you can put in the bet on a credit spread or put credit spread or
We do.
call?
We have a spreads channel.
Yeah, but you're only posting predominantly the SPX ones, right? Or
Predominantly, yes, because that's just what that's what I do. Do you predominantly just deliver mail, or do you sometimes work at Burger King?
I do both part-time.
You actually work at Burger King? I was like, that was a huge guess. Like, whoa, I got that right. And, I tell people like, okay, on Monday you don't work at Burger King, and then Tuesday you work at Starbucks, and Wednesday you're a banker at Chase, and then Thursday you go and you're the CEO of Amazon. Like, no, like you usually do the same thing every day, right?
Right.
Because that's what you're good at, right? So
Yeah.
I feel like I'm good at SPX credit spreads, so that's what I'm good at.
All right. Well, I was just trying to fill a void with
I
the
know,
call.
I know.
Great calls.
But every now and then, I'll show you. Every now and then I do. Look, here's
Because there's some days
This-
that I won't take, any of the calls.
That was a
at
profitable trade. I did NVIDIA call credit spread,
Okay, yeah.
and
I mean, I have seen you post one or two there, but
yeah, this was a good
I'm
one.
just trying to.
Apple was a good one
to the
too.
same.
But yeah, for the most part, you're gonna look at that spreads channel and be like, he only posts SPX. Like, well, yeah, because if it works, why stop doing it?
If you go down the rabbit hole of doing the back testing, which I did last night, you'll find that SPX is the alpha there. And
Yeah.
It seems a way. And being the casino and not the one betting in the casino is typically in your favor.
Yeah, yeah. I've spent, I don't know, decades trading SPY, so I'll keep doing that, I guess. All right, well, that's all I got. Any other questions? I'm here to help.
None here. Very helpful. Thank you, Ben.
You're welcome.
Just doesn't really work on a mobile app, does it?
This? Yeah, it does. Yeah.
Because I can barely see it. The reason I'm asking because I'm out on the mail route most of the time trading, even though you're telling me not to when I see your comments.
Yeah, I know.
But I'm creeping along about 5 miles an hour and stopping at a mailbox
Yeah.
and stuff the mail in and
You should
looking
be
at
able
the
to
trade.
Yeah, on the mobile, you got to kind of adjust things. Like, for example, I don't ever have this, the backtest table. I don't ever have that up because I don't need to see that while I'm trading. So that's why I hide it. I don't care about it while I'm actually trading because it doesn't do anything. I just use it, after hours if I want to tweak things, look at things, teach people things. So I keep that off. So, and then the other thing is I don't care about yesterday, the day before, the day before. I only care about today. So my mobile basically looks like this. I only want to see today.
Right.
And I think I posted photos of what the mobile version looks like in the spreads channel because I think some people were asking the same thing.
I haven't
Have you
even
had luck with
figured
the,
out how to even get it on the mobile yet. I'm not tech savvy.
That's okay.
Have you had luck with the? For some reason, I thought the alerts. It may be a me problem for a trading viewer not sending like banner notifications, that kind of thing. Does that work for you?
Yeah.
Not a me problem.
Yeah, every day I'll get a little notification down here in the corner. I get a pop-up on my phone.
Okay,
It all,
I just need to go check my settings then. I think
Yeah.
it's probably wrong.
I mean, good question though. A lot of people will, oh my God. Oh. I think, yeah, one of you guys asked me this. So if these are my settings right now, and I go in and I create an alert, and okay, it's any alert. So basically, whatever happens, I want an alert for it, whether it's a put credit spread, call credit spread, take profit line, stop loss line, whatever. I want an alert. You can do individual ones, but this basically any says whatever happens, I want to be alerted. Same with the chart, 15 minutes. If I create that, okay, it's created. It was created based off of these settings. Okay. If I go in there and I go, okay, well now I want this. Your alert that you just created has no idea that you clicked this, so it won't be based off of that. If you go, oh, I want to change this to now, I only want to be alerted for 50% or higher. The alert that you just created a couple seconds ago has no idea that you did this. So it's only going to be alerting based off of your previous conditions of whatever it was set to be. So that's what that is. It's saying 3 times stop loss, 80% take profit, 55 credit, things like that. So it's only going to be based off of what I have here. So if I want to change conditions, I would need to delete that alert. So I change my conditions, I delete that alert, and I create a new one now. Now it knows, okay, well, now I'm going to be looking for these conditions. So I see that a lot. People are like, oh, I didn't get an alert. And they look at their settings like, oh, yeah, because I changed something. Like, well, they didn't know. Any other questions? Well, all right then. I'm going to go ahead and log off and get me some lunch.